What's up traders, in today's video we're diving into a complete rules-based day trading method that performs effectively in the Forex, crypto, and stock markets. The setup we're covering today is exactly what I'd recommend if you're just starting out or if you're a trader having difficulty finding consistency and aiming to gain an edge for reliable profits. This price action method blends ideas of market structure, pullback zones, and advanced candlestick patterns for precise entries. If you're into that, be sure to smash the like button to support the content and subscribe if you're new, because we drop tons of in-depth trading tips. See you after the intro. As mentioned before, this price action trading plan is a pullback-based strategy that merges several elements of market structure with a refined candlestick formation as our entry trigger. This setup isn't restricted to any specific chart time frame, but we prefer to apply it on the 1-hour chart. It's effective across all markets, so whether you're trading stocks, crypto, or Forex, this method fits. The pullback approach aims to ride the trend by entering on retracements and is structured around two distinct trading models. We also implement two advanced candlestick setups for entry which look quite similar but carry slightly different psychological meanings. This overall strategy is built to catch strong impulsive moves during periods of high volatility in trending markets. Now let's break down the exact process step by step. The system includes three essential phases across both models: identifying the trend, waiting for a retracement, and finding an entry signal. So let's dive into step 1, identifying market direction. In this phase, we use a straightforward technique to determine the market's direction. Because our goal is to align trades with the dominant force in the market, we rely on the exponential moving average to help with this analysis. Specifically, we apply the 50 EMA onto the chart and simply observe whether the price breaks through it and forms a fresh high or low. Based on this, we can decide if the market is in a bullish or bearish phase. For instance, in this example, price moves above the 50 EMA and also surpasses the prior market structure, forming a new high indicating a bullish trend. So we can now focus on potential long setups. The same logic applies for bearish conditions. In this case, the price drops below the 50 EMA and also breaks the earlier structure to the downside, forming a new low. This signals a bearish trend, and we'll be looking for short entries. Trading in harmony with the main trend will instantly enhance your accuracy and improve your risk to reward metrics. Now that we've clarified how to spot market direction, let's move on to the second step, which is waiting for a pullback. Now, while there are various techniques traders use to spot a proper pullback, the method we follow for this strategy is quite straightforward. We simply wait for the market to form at least two candles of the opposite color following an impulsive move. This signals that the market is going through a brief correction phase. The same principle applies in a bearish setup, where we look for at least two green candles to confirm the retracement. By waiting for this pullback, we can refine our entry point, get in at a more favorable price level, and aim to capture a larger portion of the move. The third step involves making the entry. Up until this point, we've covered market conditions right. We analyzed the trend to align with the dominant market side, used pullbacks for better pricing, and observed market structure to support our overall view. Now, to turn these conditions into an actual trade plan, we need a defined entry trigger, knowing exactly when to get in and how to manage the trade, whether it works or fails. For this, we rely on two specific candlestick formations to signal the end of a pullback and the beginning of a strong move. These entry setups are advanced variations of the engulfing candlestick pattern, a well-known and powerful reversal signal in price action trading. This pattern is made up of two candles, where the second one is of the opposite color and completely covers the body of the first. Now, for the pullback strategy to work using engulfing candles, the setup must follow our specific rules for entry. Type 1, the green candle must have a larger body than the previous red candle. We need a visible color shift, and the green candle must also form a lower low compared to the red one, indicating it is a swing low. When these conditions are met, we place the trade at the close of the green candle and the stop loss just below it at the swing low. This completes our first entry. Now let's walk through the second pattern. While it resembles the first, it has one difference here. The green candle still closes above the red one, showing an engulfing move, but it is not a swing low. However, it becomes a valid entry if the red candle has made a lower low compared to the one before it that still forms a swing point for the market. The same guidelines apply to short trades. For example, in entry number 1 of the bearish setup, we observe a downtrend followed by a retracement. What we look for is a red engulfing candle with a body larger than the previous green one, along with a lower high. This gives us our swing high. We then enter at the close of that candle and place our stop loss above the swing high. For entry number 2, we again see a corrective phase followed by a red engulfing pattern, and the green candle forms a new higher high, which also produces a fractal. So these are the only valid entry patterns we will use. Any other setup outside these rules is not considered an acceptable trade. Now let's bring everything together and look at some actual chart examples. We're analyzing a bullish market on the pound 1 yen. Our chart price is currently moving above the 50 EMA and we've identified a 2-candle pullback setup, so at this point we're simply waiting for one of our candlestick entry patterns to appear in order to open a long trade. In this case a valid entry trigger has printed, so we initiate a buy trade, place our stop just below the engulfing candlestick and aim for a target that's twice the size of our initial risk. The bullish engulfing formation here signals a shift in momentum and a potential reversal to the upside. It reflects increased buying interest when it shows up at the bottom of a retracement, making it a reliable confirmation tool when paired with ideal market context. Now looking at the bearish setup, we follow a similar process. Price must be trading below the 50 EMA. Once that condition is met, we wait for at least 2 bullish candles to signal a pullback phase and then watch for one of our advanced bearish engulfing patterns as a signal to go short. The stop loss will be placed above the recent swing high and our target will be set at 2 times the risk amount. That concludes our first trading model. Now let's move forward to the second setup, but before we do that, if you're enjoying the content, make sure to hit the like button to support our work and drop a comment letting us know if you'd like more videos on price action trading or smart money techniques. This trade setup closely mirrors the first one but comes with 2 key adjustments. As always, the first step is to confirm that the market is positioned above the 50 EMA and has printed a new high in the case of a bullish trend. Next we look for a pullback consisting of at least 2 candles, but here's where the first change comes in. This retracement must reach down to touch the 50 EMA. That's a mandatory condition. This pullback must contact the 50 EMA and consist of at least 2 candles. Now here's the second added rule. Once price reaches the EMA, we want to observe a clear rejection from it. This rejection could come in the form of long wicks or a single candle that briefly closes under the 50 EMA but then quickly pushes back above. If price fails to re-enter the range right away, then the setup is invalid. After spotting a qualifying pullback like this, we then look to enter using the same engulfing candlestick formations discussed earlier. As you can tell, developing specific criteria for trade entries based on conditions and signals like the ones we've outlined turns your strategy into a structured system. By writing down each rule and sticking to your trading plan, you'll always know exactly what to do when a trade opportunity presents itself. This keeps your decision-making consistent, and that's what leads to consistent profits over time. Before executing any trade using this strategy, there's one final and crucial concept we need to cover: understanding the market structure. Since this method is designed for trend continuation, it's essential to stay alert for potential reversal signs that could invalidate the setup. We focus on 2 key structural elements: major support and resistance zones on higher time frames and classic reversal patterns. Before initiating any position, it's important to check how far the current price is from the next significant higher time frame level. Even a minor reaction at those zones could trigger a full reversal on the lower time frame, so we only consider entering a trade if there's adequate space between the current price and the next resistance or support level in the market. This step helps filter out low probability setups and positions us for trades with more favorable risk to reward ratios. Essentially, by combining higher and lower time frame analysis, we can create a more accurate and well-rounded perspective of the market, which improves both our entry and exit decisions. The second structural element to keep in mind is the presence of reversal patterns. These are specific chart formations that signal a potential shift in market direction. When a reversal pattern appears in an uptrend, it typically indicates that bullish momentum is weakening and sellers may be gaining control. The same logic applies during a downtrend. Popular reversal patterns we watch for include the double top, double bottom, and fake outs. When any of these patterns form, we approach continuation setups with increased caution because they may signal a trend reversal rather than a pullback. Now, with all of these tools and concepts in your arsenal, you're ready to move on to the next essential step: backtesting. Backtesting isn't just a suggestion. It's a must. It's the foundation of any reliable trading strategy. Testing your setup across historical data allows you to evaluate its actual performance while building confidence and consistency in your trading decisions. The more detailed and disciplined your backtesting, the more prepared you'll be when real-time opportunities show up on the chart. Now let's go over some critical points to keep in mind when you're backtesting your trading setup. Replay the market from left to right, moving forward 1 candle at a time. This simulates real-time trading conditions. Treat each setup like it's a live trade. Follow the same decision-making process you would if actual money were on the line. Stick to your trading rules. Don't change parameters mid-test. Your consistency here will define your accuracy later. If available, use the market replay tool, like on TradingView, so you stay unaware of future price action, keeping your testing as realistic as possible. Track your results seriously, as if you're aiming to generate consistent long-term income, not just win a few trades. Lastly, follow your risk management plan throughout the entire backtest. This gives you an authentic view of your setup's performance. Now, let's jump into TradingView and walk through an actual backtesting example so you can see the thought process in real time. We're looking at US 30 on the 1-hour chart. Recently, price broke below the 50 EMA and created a new lower low. That gives us a bearish market bias. We're now looking for short setups only. Higher time frame analysis. Before we execute any trade, it's crucial to align with the higher time frame to get the full picture. Now let's switch over to the 4-hour chart. Here's where things get interesting. We can clearly see that price has reached a major key level, a zone that has acted as a strong resistance in the past. The market has rejected this level multiple times, forming a double top pattern, which is a classic reversal signal. This tells us that bearish pressure is building at this level, and it's likely to act as a turning point for the price. So, from the 4-hour perspective, we also hold a bearish bias. Now that our higher and lower time frames are aligned, we can confidently look for short opportunities on the 1-hour chart. As for the target, our ideal take-profit level would be the next major market structure zone, which has historically shown strong rejection and support. This is a high-probability setup that offers a clean risk-to-reward scenario. Returning to the 1-hour chart, step-by-step analysis. Let's now switch back to the 1-hour chart and continue our breakdown. Step 1. Identify the market direction. We have a bearish bias, confirmed by price trading below the 50 EMA and forming new lower lows. So, we'll only be looking for short setups. Step 2. Wait for a pullback. We now see two bullish candlesticks, confirming a pullback formation. That's our cue to prepare for a potential entry. Step 3. Look for entry confirmation. At this point, we want the price to remain below the 50 EMA and print a valid engulfing candlestick pattern to confirm the end of the pullback. Checkmark. Here's our first entry signal. The market prints a textbook bearish engulfing candle, matching our pattern number 1 criteria. This is our trigger to enter a short position. Entry, at the close of the engulfing candle. Stop loss, above the recent swing high. Take profit, 2x our risk. R equals 1 to 2, checkmark. Next setup. We have another valid bearish engulfing candle. This gives us another short entry opportunity. Again, we apply the same rules. Stop above the swing high and target 2x risk. Warning. Now here's a different scenario. Price makes a deeper retracement and touches the 50 EMA, giving us a potential opportunity under our second trading model. The price also rejects the EMA, satisfying the pullback condition. Cross mark. However, we don't have our engulfing candle entry, so this trade is skipped. No signal, no trade. We stick to the plan. No entry. Final example. The market prints a valid engulfing setup, but this time, price has reached the higher time frame key level we identified earlier on the 4-hour chart. Since this level has been historically respected and signals a potential reversal zone, we avoid placing a trade here. No matter how tempting the setup looks, we stay disciplined and wait for a better opportunity. Let's recheck the 4-hour chart. Critical market levels. Now it's time to shift back to the 4-hour chart to reassess the higher time frame structure and refine our bias. Currently, price is sitting within a strong demand zone, a level that has previously triggered significant bullish reactions. This is a key area to watch. So what are the high probability scenarios from here? Down triangle scenario 1, bearish breakout. If price breaks below this demand zone with strong momentum, that would confirm a bearish continuation. In that case, we can expect the market to push down toward the next support area, which would become our new target zone for shorts. Up triangle scenario 2, bullish rejection. If the market rejects this demand zone and climbs back into the previous range, that would indicate a shift in momentum. In this case, we could anticipate a bullish move, and our long-term target would be the next major resistance area, which has historically acted as a significant turning point. Checkmark. Conclusion. At this stage, we remain neutral and patient. We won't force any trades, we simply let the market show its hand. Once we get a clear break or rejection, we'll realign our bias and wait for price action to print a valid setup. Let's zoom back into the 1-hour chart. Now that we've identified a reversal, the market has clearly broken above the 50 EMA, which shifts our bias to bullish. Next, we wait for the market to confirm this bullish direction by forming a new high, followed by a 2-candle pullback. And here it is. We have a valid pullback, along with our number 1 bullish engulfing entry pattern. This gives us a clear reason to go long. So we'll open a long position, place our stop loss below the pattern, and aim for a 2-to-1 risk-to-reward ratio. Bullseye backtesting note. This is exactly how you should backtest your strategy, step by step, candle by candle, as if you're trading with real money. But always remember, no trading strategy is perfect. During your backtesting, you will experience losing trades. That's completely normal. What keeps you in the game is a solid risk management plan and the discipline to follow your rules. Checkmark. Final thoughts. That wraps up this video, traders. We covered real chart examples, live trade simulations, entry conditions, and high probability trade filters. Now it's your turn. Start backtesting with discipline, track your results, and refine your edge in the market. I hope you found real value in this video. If you did, go ahead and smash that like button. It really helps us out and lets us know you're vibing with the content. And hey, if you're new to the channel, consider subscribing for more trading strategies, price action breakdowns, and real market insights. Appreciate your time, stay disciplined, stay consistent, and I'll see you in the next episode.